Hello everyone, Stan here, and I welcome you today on our streaming session, live session here at Exness. So for those of you who are new here to this format, I remind you that every week we hold streaming live sessions here on YouTube, on Twitch, on other platforms.
Everyone, Stan here, and I welcome you today on our streaming
1 second,
session,
please.
live session here.
All right. All right, we are good to go. So where were we? So we hold live streaming sessions every Tuesday on YouTube, Twitch, other social platforms in order to help you understand the market better, in order to help you analyze the market, prepare for the trading day. So this is the format which actually helps you do the homework and helps you replicate the process of professional trading. So let me tell you a few words about myself. I'm in the markets and trading since 2004, so pretty much more than 20 years. My first trade was in November 2004, so already I would say more than 20 years. Anniversary. Okay, so my path in trading was not simple, or I would say was not easy. So I tried many things and I tested everything, on my own funds. So there were no good education back then, no good connection, and brokerage services were so spreads were pretty high, spreads were pretty wide and unstable. So that was a wild west, I would say, in trading. But now, of course, the situation is so much easier for you guys who are entering the industry today. So execution is light speeding, spreads are narrow, execution is fast, especially if you work with such brokers as Exness. So you will be your trades will be in the market in no time, without any delays, without anything. So of course, for scalpers, for day traders, so the situation is much easier today. However, markets are not becoming easier as complexity of the markets increases, right? Because the more market participants are pulling in the market, the more funds, the more money are getting in, so markets are becoming more complex. I don't say that it was easier to gain profits 20 years ago. That's not, but sometimes models start changing over the time, and the basic skill for a trader is to adapt, is to be able to adapt to fit into the market, to learn what works, what doesn't work, to test models, test strategies, and actually make conclusions out of the data. So that's what trading is about. But in the first place, I think there are evergreen strategies which work in the market in the first place. What do I call by evergreen strategies? Well, I mean that there are things that don't change in the market for 20 years and maybe 100 years. So first of all, there are trends. Trends will be always there, regardless of what will change in the market and in terms of microstructure, regardless of HFT algorithms coming in. So trends are not going anywhere. So sometimes there are big trends. For example, gold was a notable trend in the first quarter of 2025. So sometimes there are crypto trends on Bitcoin. Sometimes crude oil is trending, Japanese yen is trending. So there are trends in the market that is not changing over the years. Secondly, volatility. So volatility might be on your side if you do cook it correctly, I would say. So volatility is also not going anywhere. Volatility has cycles. It has low volatility cycle, high volatility cycle. So if you know how to play breakouts, how to play momentum strategies, so you might also have an edge, because momentum strategies are also not going anywhere. So these are two, I believe, evergreen strategies which might be used: momentum trading, trend following trading. Counter trend trading also might exist in the market, because many breakouts are being false, but I believe that's more associated with fine-tuning your entry points, because you might want to actually find exact entry points to improve your timing, market timing. So that's where false breakouts come into place, especially for day trading. No sound. People are saying that there is no sound, which is interesting, because I think I have the sound. Entry points to improve. No, I should have the sound, I think. So please give me the feedback if there is any sound in in the streaming. So give me just a second, I will check it out once again. One, two, three, sound should be on, I think. So while we're checking the sound, one last preparation. So let me check it out. There's no sound, right? 1, 2, 3. 1, 2, 3. Sound should be on. So let me check. Let me double check, please. There is no sound. There is no sound. Okay. Let me double check. No sound. So let me check. Let me double check. There is no sound. According to my perspective, yes, there should be sound. Yeah, thank you. Yes, there should be sound, guys. So if there is no sound, please check your I don't know, headphones or anything else. All right, I think with that we're good to proceed. All right, so I think that without further ado, let's go straight to charts. And first, let's start with observation of those ideas which we've been building throughout the last 2 weeks. So let's straightly go to the charts. People are saying there is no sound. Positive mind, African voice, no sound, no sound, no sound, sound clear. Thank you very much. Thank you, Positive Mind, for confirming that there is sound. So by the way, guys, you can tell us in chat where are you from, what are you trading, what are you monitoring today. So I will read chat from time to time and answer your questions if you have any. So don't hesitate to drop comments to here at YouTube chat. So unfortunately I don't see any Twitch here, any other platforms, but if you want to really communicate, so please come to YouTube. So I'll be more than happy to answer your questions. By the way, drop the link for this streaming session to your friends, fellow traders. So I think they will appreciate that because we really have a good stuff here. I think pretty useful. All right, so yeah, so what I want to show you here is the, wait a minute, 1 second, display capture. Okay, so let's quickly go through those ideas. So first of all, the first idea was the Euro USD, which we've built not so long ago. The opposite reaction. So I think that we might get on board of a pretty good swing, pretty nice swing, maybe rewriting the high. All right, so that was the first idea for Euro USD. I think it played out pretty well. Not that I want to brag or anything here, but here I want to show you some logic, guys. So the idea for Euro USD was actually based on the fundamental money flowing in 2 weeks ago before. So the position of the market was near the 200-day moving average and 20-day moving average, which is the aggregation of really strong, important support levels. So with that, when the market actually started to reverse after Trump announcement, after Donald Trump had announced tariffs, so Euro USD had skyrocketed to the new peak. So that was the first idea. Another idea was Bitcoin short. Bitcoin also, as we see, so it consolidated for a little bit, maybe so for a smaller number of days than I expected, then it has gone short. And another idea, so basically it's Euro Yen, it's still in play, and we might still notice the possibility of Euro Yen potentially reversing and going higher because market conditions might be actually still in place for Euro Yen. All right, so with that we are transitioning back to charts, and let's start the analysis right away. All right. So what I want to see in the first place, I want to check the performance of benchmarks, major benchmarks, the first of which is the American dollar index, which I want to really check out today. Daily chart of DXY, the American dollar index, shows some pullback, and we see that the dynamics was pretty controversial. The first reaction on tariffs announcement. So I remind you guys, for those of you who are not monitoring the situation, that Donald Trump, the president of the United States, had announced worldwide tariffs, including inhabited islands like McDonald Island, where only penguins live, and which is weird. That's being commented by a lot of analysts all over the world. So they're thinking that they didn't think it through carefully, but I don't know actually. So let's not make any conclusions. So the things are what they are, and here it is. So the first reaction was the decline of the American dollar. Then the next reaction was a growth. Why is that? So the growth was seen as a reaction to the substantial decline of the stock market. So which we've seen in form of S&P 500 showing the two really bad days throughout the last week. So now we had the pullback yesterday, but there was a really black week, I would say Black Wednesday, whatever you call it, Black Thursday. So I think that was the worst drop since COVID-19 of 2020. So there was a drop of the markets in March. So the same situation was observed for S&P 500. Nasdaq was also on the verge of really collapse last week, so which is not expanded this week. But there was a notable decline. So with the rise of volatility towards 60, VIX as a volatility index of the United States, S&P 500. So let me quickly show you. So it is here. VIX. So let me show you VIX really quickly. So I want to show you. So now it's 43, but the peak of VIX was as big as 60. So that means very, very high level of fear. So let's record this number and you will see that actually volatility is very high. So what conclusions do we have out of that? When the volatility is so high, so many models stop working as you expect it to work. For example, RSI, stochastics, indicators, overbought, oversold conditions, so they might not work as you expect, because probability theory, the two standard deviations principle involves the observation that the market holds 70% of the time inside of the trading range. But whenever you have the volatile cycle, so this observation breaks. So there are fat tails appearing in the distribution of the data, meaning that, for example, if the market collapses, it's not retraces, it ignores some important support levels, resistance levels, and it just, falls beyond those support resistance levels. You should be careful about that, guys. So now volatility is pretty high still. The level of fear is not 60 like it was a week ago, but it's still 43, so it's still pretty high. Of course, the first relation to this principle is to S&P 500 index, but all markets are affected generally. All right, so yeah, let me read chat for a little bit. So Dubai here, Nigeria, Delhi, India, Ghana, hello, and gold. So check for retracement on gold. All right, so gold it is. So let's start with gold today. So guys, remember that last week we've been pointing out the overbought condition of gold. So just if we put here the simple indicator called Bollinger Bands, that indicators might fail in volatile markets. But so that's what we had actually. So we had gold emerging from the range, from the top of the range here, exactly. And that was the overbought condition which was evolving in the markets. And so we've been pointing out that that might not be the best course of action to buy gold. Ahead of that, so there was a possibility to find a day trade. So I was also mentioning that in the stream, that if you hold a trade, if you find a trade, so the best course of action would be just to find a day trade and not to hold it overnight. Otherwise, you hold substantial overnight risks. For example, that might be, just like that, very small piece or chunk of this move on the false breakout to the downside. Another one, if the market breaks to the downside. So the best what you can capture out of this market is to take the small piece of the move. But all right, this situation is already over. So what's going on now? So let's start with the daily structure. Daily structure points to the price falling below the it's not below the Bollinger yet, okay? So it had not tested yet the lower band of the Bollinger, it would be somewhere here. So I think we still have some capacity for the market to reach this area, something like that. There's no guarantee that it will reach this area, of course. So what also do we see? The market had tested the previous static support, which is the horizontal level, the correctional level from March 2025. It is here. So that was static level of support. So now the price is trying to establish the new dip. But in order, all right, so another thing, so the last thing, so let's put the 200-day moving average here, so which is the long-term support, in order to understand where are we in relation to the long-term trend. We're still far above the 200-day moving average, so meaning that probably we are still in the uptrend, and the uptrend is pretty obvious, so that's a no-brainer. We just need to figure out whether the uptrend is active or not. Well, obviously the market started to consolidate, so it transitioned to the consolidation. The potential location in relation to this trend is the position inside of the value area, okay, because that's the 50-day moving average, which price testing right now, and above, slightly above the price action, it is the 20-day moving average. So that's the location which we're positioned right now. So basically anything that happens inside of this area or maybe below this area might treat potentially as a pivot point, as a reversal point for the market to go higher. Something like, maybe something like that. So such good trends, they very rarely reverse quickly. On the other hand, so the best thing that we can rely on, what we can get from it, I think, is a consolidation. So that might be, I don't know, the continuation of a trend. You never know, right? Because that's gold after all, so it can reach 3,300. So that's a question mark which we put here, okay? That's a question mark, but the main thing here is we for sure we can actually anticipate this move, but we are not sure about this move, because this move is the continuation of a long-term trend, so that's not clear yet. In order to understand how gold reacts to the volatile market conditions, so we might go to previous meltdowns and see how gold actually reacted to volatility spikes. So with that, let me go to trading view, and I want to show you some figure from COVID crisis, okay? So let's trace back to the 2020 March, for example, 1st March of 2020, okay? So here it is, by the way, the COVID crisis. Gold was in an uptrend back then also. So after the initial drop at the end of February, so it had tested its high. But the real volatility came in the second decade of March. So let's also compare this action to VIX, to volatility index. It's not actually visible, I think. Let's put regular chart here. All right, so just the volatility was actually high. The stock market was falling down like a straight line. So that's what we see here. So what gold had made here, so that was the 1, 2, 3, 4, 5, 6, 7 days of a decline where price had tested 200-day moving average, then it had reversed and continued the rally. So yeah, the price was different. It was 1500 back then. Now the price is different, but the overall idea is that gold initially, when the initial volatility breaks, it's also reacts with a decline, it liquidates, then several days after it starts being supported. So in our particular situation, I think that we might take this as a potential reference, that we should be probably a little bit more patient, because currently there's a meltdown that we see in the markets. Well, maybe it's not being escalated yet on Monday and at the beginning of the day on Tuesday, but still there is a big risk of market falling through the support. I mean the dynamic support, and maybe I don't know if it will reach the 200-day moving average, but I'm afraid of escalation of this decline because volatility actually is pretty high. So liquidation, when the market liquidates, when people are going back in cash, investment companies are going back in cash, might be also escalating to the gold market. So after that, so if it stabilizes, if the market stabilizes, if it retraces, so we might see the further continuation. So I think that the excellent trade might happen somewhere, maybe here. We never know exactly where the buying power or buying activity will return, but that might be the potential continuation here. So this week, guys, we have the CPI publication, the inflation print for the United States. So maybe that will turn things around a little bit, right? So that's why that's where we go to economic calendar, by the way. So we need to check it before we get to trading. So two major publications this week. The first is FOMC minutes on Wednesday. It's got to be late in the day on Wednesday. So for those of you in European time zone, so it's got to be evening. For those of you in Asian time zone, it's got to be late in the night. So I think that South Africa and Africa in general and India, that should be somewhere between 7 and 10 p.m. So what is that? These are protocols of interest rate meeting for the previous interest rate decision. So that might create some volatility. It's not that huge, but the market want to figure out whether hawkish or dovish scenario for the upcoming meeting in May will prevail, because market is unsure about it yet. And let me show you the FedWatch tool. So that's really important, guys. So cmegroup.com/market/interest rate/CME FedWatch tool. Go in here in March. So currently there is an intrigue. So probability of interest rate going 1/4 point down is still considered as pretty low. It's 30%, but it's not nothing. In June, by the way, so it's already we have 68% of traders aware that the Fed will drive the interest rate down. But according to the FedWatch tool, according to the historical charts, so at least for now, that's not yet clear whether or not so we will have anything in May. So because already 38% of traders are thinking, so it's a slight increase, that interest rate might go down. So that's an intrigue. So Wednesday is an important day. We will see the protocols, how many people have voted for keeping interest rate at the same level, and how many people have voted for declining it for 1/4 point. Another important publication, of course, is what is inflation for the United States on Thursday, the CPI, the core inflation rate. So for that, we are referring to tradingeconomics.com/calendar because it has forecasts, consensus forecasts being published here that might be important. So the previous one is 0.2%. That's a growth month to month. Consensus is 0.3, so inflation is expected to stay tight a little bit. And if the number is smaller than projected, so that might send to the market a recessional signal. So markets may collapse. I mean, stock market may collapse again. So let's monitor for this publication very closely. And the gold might actually continue to move higher in this case, in this particular case. So I think that even if this inflation publication still fits expectations, so American dollar is still under pressure this week, and we might still find any interesting opportunities in other markets, for example, Euro USD. All right, so two major publications, FOMC minutes Wednesday and CPI publication on Thursday. With that in mind, so let's go back to charts and try to understand what we will have. So currently I think so Thursday might be an important publication. So Wednesday, Thursday, let's watch the publication of inflation on Thursday. So if the inflation will be lower, slightly lower than expected, so I don't know, maybe gold might pivot here below the support. But I think the better trade, the more logical trade in this situation would be the bet against American dollar, so DXY. In that case, what do we have here? So the obvious reaction of American dollar for the weaker inflation might be the decline, okay? Something like that. But I think the instrument which you might use for building a trade is actually Euro USD. So now, as you see, the Euro USD is located in a pretty strong upswing, which was triggered by the sharp move last week, which Donald Trump, President of the United States, had helped this market to jump above the Bollinger. But currently we see that still the market structure points to a strong trend following situation. So again, we are referring to that swings. That swing is still on. We are still pointing to the upside. Currently we have 3 days down, 1, 2, and 3. That's Wednesday. That's Sunday, so that's not counting. 3 days down. So today is the third day. Well, let me just check really quickly. So 4th is Friday, right? So 4th, 7th, and today is 8th. 4th, 7th, 8th, right? So tomorrow tomorrow is Wednesday, and tomorrow might be the pivot point potentially for Euro USD. So I will be monitoring for the situation, because if this trend still persists, if the trend is still strong, so the 4th day of the trend, of this correctional trend, might potentially mean the reversal. So that might be the reversal point, just the same as it had happened with the gold market not so long ago. So you remember the situation, right? The structural imbalance, structural continuation. Here it is, right? The peak, and then 1, 2, 3, the 4th day, we see the trend continuing. So if the trend continues in this situation, so that might be the long entry point. The same is for Euro USD. So if the trend continues, so that might be the good continuation point. There is no guarantee that the trend will continue, but if you want to jump in the trend, so probably the market timing here might be much easier and much stronger if the market breaks between the 3rd and the 4th day. What speaks for this trade? Not just technically. Technically, we understand the situation is pretty strong, right? So it had started here. So the strong fundamental money flowing in, yields of government bonds of Germany, bonds, so-called bonds, they were increasing. So currently we're in a strong uptrend. So American dollar is declining. Treasury bonds of the United States are growing. So yesterday there was a decline, but they are growing. So let me show you one interesting situation. So if you go to cmagroup.com and put here ZB. ZB is the Treasury 30-year Treasury bond future on the CME Group. Volume and open interest is what we're interested in here when we analyze it. Let's click it here and you see that currently it's declining a little bit, but the volume and open interest has been consistently growing here since March 26th. You see that we are on the rise of this market. So more money is flowing in, open interest is going up, volume is going up. So that's interesting. So meaning that Treasury bonds of the United States is considered as a new heaven. Markets are transitioning capital back to Treasury bonds. What does that mean? So whenever this market goes up, yields of government bonds are declining, meaning that the American dollar gets under pressure. So the less and less money actually starts investing in this market. So that's an interesting situation. Volume and open interest increases, but the yields of the currency are decreasing. And the currency rate should also decrease to compensate this difference, okay? To compensate this difference. Why is that? Because previous big portfolios of bond market managers, so they are starting to show some increase of their positions in treasuries. So they have to sell some position in treasuries to invest in other bonds. So, and to do that, they need to make conversion operations in the currency market. In other words, when this market goes up, American dollar usually goes down. That's a pressure. That is a pressure. Of course, this market is very dynamic, so it's not static. So for example, if you Google 30-year treasury yields and go to cnbc.com to see whether you have any dynamics here, you see that yesterday we had a pullback, right? So yields are not just declining like that, but the trend for the previous week was a decline. Now, the beginning of the week, it's pullback. But if it continues to decline, so that will represent what? It will represent the pressure for the American dollar. So let's keep that in mind. So if the pressure for the American dollar will prevail, will go back again, so we might want to position ourselves on Euro USD. And guys, so we are not just referring to the last 3 days, we are referring to the action that was unfolding throughout the last maybe 2 weeks or so. Money is flowing to the treasury bonds, which we see in the form of futures. So that's pretty big position. That's a pretty big position, okay? So now I will show you another perspective here, how to